Hi, so today we're going to talk about plant assets. Plant assets is also known as plant property and equipment from our previous lessons. Now, just a refresher, plant assets are tangible assets with a useful life of more than one accounting period. These are permanent accounts and they are reported in your balance sheet as part of non-current assets. Now, they are used for operations. For example, if you buy land, your land should be used in your business. But if, for example, you just bought the land as a form of investment, then that will be recorded as part of investments in your balance sheet. Now, for the equipment, you have to really use the equipment in your business. Otherwise, if, for example, if you are in the business of buying and selling furniture and you bought a chair, and this chair you intend to sell it in the future, then this would be part of your merchandise inventory. The only time that you will record chair as part of your plant assets is if you use it in your office, in your business. Okay. So let's look at this picture here. In front of you, you can see a building and land. Now, for the land, let's say you want to use this piece of land for your business, but it just so happens that there's a building already there. But you really want this location. So what do? You purchase this piece of land, and once you've bought it already, you will incur additional costs. And some examples of that would be the demolishment of this building, the transfer of title from the previous owner to your ownership, and that will determine the cost of your land. So let me just pull out the formula here. Okay, to determine the cost of land, aside from the purchase price, the actual purchase price of the land, you will incur additional costs such as the closing costs. So you would have to hire lawyers, you have to pay the title fees, you have to pay commissions to the respective individuals that will help you close the existing business. So if, for example, there's already a business in operation there, you need to pay lawyers to make sure that this transfer of ownership will be carried out smoothly. And then there's also the clearing cost. So let's say you don't want the building, then you have to demolish it. So that would also add value to your land. Now, there's also this item here that's called salvaged material sold. This pertains to, let's say, after you demolish the building, you sell portions or parts of that building, say the metals, the glass, and by doing so, you earn money. Right? Now, this money would somehow fund your purchase of the land, so that will decrease the value of your actual cost of the land. Given that, the value of the land that you will report in your balance sheet will be the final value after considering the purchase price, closing costs, clearing costs, and then subtracting the salvage material sold from the previous items. Now, let's say in a different situation, you are walking around Makati and you actually realize, oh, I actually want to have a building here in Makati for my business. So you see these set of buildings, and then you particularly like this one, this yellow building. So what you do is you decide to buy that building. But the thing is, aside from buying the building, you have to acknowledge that there are already people inside the building, that this building is owned by a previous corporation. So you have to incur costs for this building to be used in your business. So what are those additional costs? Additional costs would be the closing cost. So you need to pay taxes and titles to have the ownership of the building transferred to you. And then it's also possible that when you went inside the building, you realized that it needs updating in terms of electrical wiring, flooring, and then you want a better ambiance, so you pay for renovations. That would add to the cost of your building. And then let's say you want to add another floor or another room, or maybe perhaps a basement. That would add to the cost of your building in the form of construction. It's also possible that you need an interior decorator, so there's also a design fee. You have to secure permits when you want to construct an additional portion to your building. So all of these things would add value to the building, and the final value here will be reported in the balance sheet as a cost of your building. Now, there are other items that will be considered as plant assets, or they would be considered under plant property and equipment. This would be land improvement. The example of land improvement would be parking spaces or driveways, fences, shrubs. And unlike land, they actually depreciate. So here, in this case, since they depreciate, the land improvement would also have an estimated useful life. If, for example, you decide to add the parking lot in your area, or let's say you want an additional driveway, this would be recorded as a debit to land improvement and then a credit to cash in your book. So if, for example, you pay on account, then use accounts payable or notes payable. Okay. So let's say you already have your building, your land improvement. Now, you need a photocopying machine in your office. So let's say that would fall under machinery and equipment. So let's take this as an example. You have a copying machine. So you bought that machine from, let's say, an electronics store or a gadget store or an appliance center. So that machine would, of course, be taken into consideration when computing for the cost of machinery and improvement. But the thing is, sometimes you also have to incur transportation expenses or insurance while it's in transit or while it's being delivered to you. If, for example, you're importing this equipment from another country, then you also have to pay taxes. Now, what would happen here is this would increase the value of your machinery. And then, let's say once it's in your building, you need to make it work. So you hire someone to assemble, to install it, and to test if it works. So that would also be part of the additional cost of your machinery. So after taking consideration all of these things, the final value here would be added or would be reported in the balance sheet as the value for your machinery and equipment. There are instances wherein you buy in bulk. So let's say you see this patch of land and then it has a building already. You like that building. Then you see there's a parking space already. And what you do is, instead of just buying one portion, you decide to buy everything all at once. In some books, this is called lump sum purchase. Some would call this as group purchase, bulk purchase, or basket purchase. Now, let's take this as an example. Let's say you are Happy Houses. So, Happy Houses paid 900,000 pesos to acquire a group of items consisting of land, appraised at 300,000 pesos. So, appraised is a term that's synonymous to valued at. So, group of items consisting of land valued at 300,000 pesos. You can put it that way. Land improvements valued at 100,000 pesos. And a building appraised at 600,000 pesos. Okay, so let me plot that out, the given numbers. Okay, so what you see here, what you will notice is that when you add 300, 100, and 600, that doesn't actually equate to 900,000. Add all these three and you'll get 1 million. Now, if you think about this, if they are unequal, then how can you make your journal entry? Won't your debits and your credits be unequal as well? And we all know that in journalizing items, it's a crime for you to have unequal values in your debits and credits. So this is how you actually do it. First, you compute for the total appraised value of the items that you bought. So that's 1 million. Okay. And then what you do is you get the percentage of the total. So what we're saying here is this 1 million would be composed of 3 items: land, land improvements, and the building. If this is the case, okay, what's the percentage of this? A certain percentage of this amount would pertain to land. And then a certain percentage of the 1 million would pertain to land improvements. And then a certain percentage would pertain to the building. If this is the case, to compute for this, we just divide 300,000 divided by 1 million, we get 30%. Okay. You can multiply 100 to express it in percentage. Okay. And what happens here, so you're saying 30% of this 1 million is composed of the land. So we do the same thing for the other items. 100,000 divided by 1 million times 100 will give you 10%. And 600,000 divided by 1 million will give you 60%. Now, after doing this, we then multiply each percentage to the total cash out by happy houses. So in this case, okay, 30% times 900,000 will give me 270,000. 10% times 900,000 will give me 90,000, and 60% of 900,000 will give me 540. If you notice here from this table, this land, which was originally appraised at 300,000, became only 270,000 when we bought in bulk. Same goes for land improvements. The apportioned cost is much lower than the appraised value. And also for the building, instead of paying 600,000, we only paid 540,000 for the building. The reason for this is somehow we get a discount because we bought in bulk. So in this case, instead of flashing out 1 million, because we bought all of these items in one go, we only needed to cash out 900,000 pesos. And so, when we journalize the transaction, we disregard the appraised value and instead we focus on the apportioned cost. Therefore, we bought land, so debit land 270,000, debit land improvements 90,000, and building 540,000, and then cash out will be 900,000. Now, in the next video, I'll start talking about depreciation.